as some of you may know from my books, I have a long history in the field of machine learning, starting not in finance, but at IBM T.J. Watson Research Center in their Human Language Technologies group. So, however, I have found over the years, until recently, that it has been extremely difficult to actually extract value from applying machine learning to finance. And I will talk a little bit about that why later on. But it is only in maybe, it might surprise you, it's only been a year and a half or so after I re-engage, so to speak, machine learning, that I have found value in it. And that we continue to find value of applying machine learning, but in a way that I think most people are not doing. And that's also something that I would talk about at the end. So why is it that suddenly I become re-engaged in machine learning, you might ask? Well, for those who have read my books, you might notice that I have always advocated simple models, simple strategies as the most likely path to profit. And what simple means, what simplicity of models mean in a technical language is really single factor model or linear model. And those models, for example, a favorite pair trading strategy would be to compute, let's say, the spread between two stocks, let's say Google versus Apple, and you look at the spread and you create a Bollinger Band around them, and if the spread is greater than the upper band, you short the spread, and if it's more negative than the lower band, you buy the spread. So these strategies are perfectly linear, right? It sounds simple, and in fact, it's simple. Everything is linear. There's nothing complicated about it. And they have worked very well. I mean, these are the foundation of quantitative strategy since, the 1980s, perhaps. People have made billions out of these kind of simple models and extensions of it. But nevertheless, in recent years, more and more people enter the quant trading field. When I first wrote about quantitative trading back in around 2006 in my blog, I became very popular on my blog. Why is that? I mean, nowadays you can find a quant trading blog, everywhere. If I were to start now, nobody would read my blog because there's so many of them. But at that time, one of the reasons my blog became so popular was that I was the first to write about it. So you could see that even so as recent as 2006, quant trading belonged to the is a very niche area of trading, and not too many retail traders know about it. And certainly many of the more traditional funds are not practicing it. But nowadays, you have a quant finance program in practically every reputable university, and so it's no surprise that with the large number of people engaging in quantitative trading, these single factor linear quant models become less and less profitable, just simply due to competition. And so that's the dreaded alpha decay that people talk about in trading. Now, interestingly, another reason why machine learning was not particularly successful, was not very well applied to finance, was the issue of overfitting. In a simple linear model, there are just a couple of parameters that you have to adjust. Sometimes these parameters are so obvious that let's say Bollinger Band. Let's come back to our simple example of Bollinger Band, right? So nobody would dream of setting a Bollinger Band with at a 10 standard deviation. You will never get a trade in if you have a Bollinger Band that is as wide as 10 standard deviation. Typically, it will be 1 standard deviation or 2 standard deviation. So this parameter, namely how wide the Bollinger Bands are going to be, are practically intuitive and obvious. There's a simple number that that would be obvious to everybody. But in a machine learning model, typically there are hundreds of parameters. And in a neural network, there'll be thousands, tens of thousands of parameters to fit. Most low frequency financial time series data does not have enough data points to support fitting all these parameters. So it is extremely easy to overfit to financial data, especially low frequency financial data, like daily, for example. However, in recent years, as you know, most of the advances in machine learning proper, even in neural network, are basically advances in avoiding overfitting. For example, neural network wasn't that useful prior to, let's say, 5 or 6 years ago, until Dr. Hinton at U of T discovered this technique called dropout, which revolutionized neural network and bring in this notion of deep learning. I mean, the whole field of deep learning practically cannot exist until they overcome this overfitting problem due to the invention of the dropout technique. So similar advances in other other algorithms of machine learning has also made has also let us overcome overfitting to a good extent. Things such as random forest. So when I was first applying machine learning, we are already familiar with classification and decision tree, for example, but random forest is still rarely used. I think the research was done, but it was not really practiced widely to create an ensemble of trees. But nowadays, a high school student would have used random forest to train machine learning model. Nobody would dream of using a single tree to make prediction. So that's to go from a single tree to a random forest is yet another example of advances in machine learning proper that allow us to overcome overfitting. So there are, of course, other techniques, cross-validation, and as I mentioned, dropout and so forth. These are all techniques that have created, has reduced overfitting. Now, there are other tools outside of this reduction of overfitting that also serve to make machine learning more transparent. These are techniques that are more for human consumption than for the machine. So traditionally, a lot of the criticism of applying machine learning to trading in particular is that this is a black box process. Many money managers are uncomfortable with black box trading. They want to understand why we make this trade, and for good reason. Because if you are losing an investor millions of dollars, you need to explain why, right? People will always ask you, why did you make that trade? And if you are running a machine learning model, you can say nothing. You say, I don't know. It's like, we have 100 decision tree in the random forest, and that's what they decide, right? Well, you got to be doing better than that, because if you keep saying that, and of course, if you make money, nobody asks you. When you make money in trading, you are God, and no one dare to question you. You say, who cares? You're making money. But when you're losing money, and you bet you're going to lose money at one point in your career, unless you are Jim Simon, you will be asked this question, and it will be very painful if you cannot explain it. So there are new tools in machine learning that make the answer more intuitive, and that tool is called feature selection. So in machine learning nowadays, there's a big area of research called interpretable machine learning models. And one major part of interpretable machine learning model is that we would like to know what are the important features, because even if we cannot understand exactly why it make that prediction, at least we want to know what are the important inputs to this machine learning model, that lead to that conclusion. For example, typical machine learning model would in finance would benefit from more than 100 inputs. If you don't have more than 100 inputs, you are not really, maximizing the utility of a machine learning model. I have seen a lot of my clients using 5, 6, 7 inputs to a machine learning model. And I said, if you only have 5 to 10 variables, why don't you just use linear regression? Why don't you just use logistic regression? There's no point to use a random forest when you have only like 5 to 10 variables. You better create 100, 200, 1,000 features to feed into machine learning in order to really benefit from machine learning. However, it does not mean that all 1,000 variables are useful. Most likely, most of them are useless. They are just noise. And the process of feature selection is designed to explain, to rank these features and to tell you that, hey, yeah, you enter 1,000 inputs, but really, only 20 of them are important. And let me show you what they are. And that is a very powerful, intuitive, interpretable understanding of a machine learning model that you can tell investors. Investors say, what make you lose us 10% last month? And you tell them that, oh, these are the important variables we look at, and look, they behave really weirdly in the last month. No, look at, let's say, for example, FIX. Hey, FIX had a move that never happened in the last 10 years. So, since FIX is an important variable in our machine learning model, no doubt, because it behaves very strangely, the model made the wrong decision. And people say, okay, now I understand, too bad we may lose money, but things like that happen in finance. Whereas if you can't explain what are the important variables and why they behave strangely, people lose confidence in your model. So finally, one last reason I would say of why machine learning are now more popular is because it can be used for risk management and capital allocation. It should be, in my opinion, not only can be, but it should be used mainly for risk management and capital allocation, and not a primary signal generator. And that is because I have tried to make it work as a primary signal generator, and it has never worked so far. But we have find it to be extremely effective for the purpose of risk management and for capital allocation. And that is one reason why I believe there's a renaissance of applying machine learning to finance, is because of these kind of usages, not primary signal generator. And you might ask, why is that it is hard to make it work as a primary signal generator, but easier to make it work for risk management? There's a very simple reason. For a primary signal generator, we are applying machine learning to predict the market. For example, we want to predict if the Apple is going to go up tomorrow. We want to predict whether gold is going to go up tomorrow. Those sorts of things. Well, you are not the only one who are making prediction of whether gold is going to go up. So many machine learning programs are competing for the same prediction. And clearly, if there is detectable pattern in the past, it would have been arbitraged away by all these other machine learning programs. If everybody's trying to predict the same thing, clearly, a lot of people will succeed, and that prediction will no longer be accurate. There is a certain, what George Soros say, a reflexivity in the financial market, and that is completely different from applying machine learning to other fields. For example, let's say you're trying to use machine learning to read radiologists' charts, right? Charts of MRI scan, right, or of tumors. Well, if your machine learning program can detect cancer with an accuracy of 90%, it is going to stay 90% because the tumor is not going to evolve just to avoid the detection. But that is not true for the financial market. The financial market will evolve if you are able to predict it. So using machine learning to predict directly the market movement, I think is foolhardy, because do you really think that your machine learning program can beat Renaissance Technologies machine learning program? Do you really believe that your machine learning program can beat Two Sigma's, DE Shaw, Citadel's machine learning program, or even Google's machine learning program? I think it's highly unlikely. Therefore, I think it's foolhardy. However, if you see an edge that only your brain can come up with, and you use machine learning to predict whether your signal is going to be right tomorrow, that is private information because nobody else has your model. Your model, may be a simple Bollinger Band model, but nevertheless, it is not publicly available. You don't see necessarily on Yahoo Finance. Yahoo Finance would report every day the Apple price and the Google price and so forth, but they're not going to report, oh, the Bollinger Band spread between Google and Apple is such and such. That's not something that everybody is trying to predict. And even if they're trying to predict, they're likely to use different look-back period for the Bollinger Band. So you are still not trying to predict exactly the same thing because some people might use a 5-hour Bollinger Band, some might use a 1 day, some might use a weekly Bollinger Band. So they're all going to be different. And because of that, and if you are trying to use machine learning to predict those spread, for example, or predict the outcome of your pair trading strategy, that is we essentially predicting something that are private information. And no two trading strategy will be identical because of the slight change in parameters. And if you are trying to learn from those trading strategy, you are not competing with all these other hedge funds and getting arbitrage away your predictability. And that's why using machine learning for risk management and capital allocation of your own trading strategies is, in my view, a much more likely way to succeed than to predict the market directly due to the notion of reflexivity. So let's talk a little bit about traditional quantitative and trading strategies versus machine learning based strategies. So in traditional quant strategy, as I said, there are typically few parameters. Few predictors, not parameters. Yeah, few parameters too, but also few predictors. In machine learning, there are numerous. There are, in traditional quantitative strategy, typically you are going to model prices and fundamentals, namely traditional data. Whereas in machine learning, typically you will use it to model alternative data because it is very hard to build a mathematical model on alternative data. But it is easier to build a mathematical model on prices, certainly, and even on company fundamentals. There are pricing valuation models, which every CFA student, every CFA holder is supposed to know, right? How to value a company based on fundamentals, right? So those are traditional data, but if you present a CFA holder, charter holder, with a whole bunch of, with 1 billion rows of credit card transactions and ask her to come up with a valuation of this company that has 1 billion lines of credit card transaction, I think she would be somewhat at a loss. So here's where machine learning can help. As I said, traditional quant model is linear and machine learning models are non-linear. The importance of non-linearity is that not all the features will be used. When you have a linear model, it is very hard to get rid of some features, although there are techniques called shrinkage, which can help you, but it is much more effective in a non-linear model where some of the, let's say some of the neural network, some of the nodes in the neural network can just have 0 weight, and that's no problem. And also the non-linearity can take into account the nonlinear dependency of the model. And what I mean by that can be illustrated in the following example. Let's say, when the fix, which is the volatility index, the fix index, let's say when it's low, the S&P return is perhaps follow some kind of a linear relationship with the economic growth. So, so the economic growth typically, if it's higher, then the SPY return will be high, provided that the fix is below, let's say 20. But when fix is above 20, that relationship could break down. Now, this kind of regime, in the predictor space cannot be modeled by a linear model. It's just not possible, right? But in a non-linear model like a random forest, they can be handled very easily. You just have a rule that says, okay, on one branch of the tree is when fixed is greater than 20, and on the other branch of the tree is fixed less than 20. So on this branch, we have this relationship between the economic growth and the SPY return, and on the other branch, maybe there's no relationship. You shouldn't use economic growth to predict SPY return. So this kind of a nonlinear dependence of the predictors can be easily handled only with nonlinear models. There's a pro for traditional quant model. They're easy to understand, but because it's easy to understand, it's easy to replicate. So alpha decay will set in the moment you set it in motion. Whereas in the machine learning model, they are unintuitive, they are opaque, they may be black box, but because they are so difficult to understand, because no two people can build the same machine learning model, alpha decay is less likely, right? Because even if you give me the exact same features, which is unlikely, you and I, let's say we both try to predict Apple return, most of our variable might be similar, but it's not likely to be identical, this predictor set. It's going to have some difference. Even if we are all using, let's say, 10-day return, maybe you normalize it by volatility and I don't. So that's a slight difference in input, even if fundamentally they have big overlap. So no two machine learning model will give you exactly the same trade. And therefore, alpha decay is less likely. In traditional quant model, there's a big problem, is that it will tell you either to buy or sell, right? You say, oh, Bollinger, it exceeded the upper Bollinger Band, let's short it. Or it exceeded the lower Bollinger Band, let's buy it. But it won't tell you what is the likelihood of success of this trade. In machine learning model, you can. You can say, oh, the machine learning model will tell you to, hey, buy Apple today. And you will have a probability of 51% that it will go up tomorrow. It will tell you probability, and that is very important because probability allow you to allocate capital. If you are very certain that Apple is going to go up, allocate more capital to this trade. If you think that it's borderline successful, allocate less capital. Or if the probability is really close to 50-50, don't even bother to trade. In traditional quant model, as I said, it's very hard to overfit because there are few predictors, it's very transparent, and it's linear. So it's hard to overfit. Not so with machine learning model. In traditional quant model, there is also one problem. It is that it is very hard to assess the statistical significance of your backtest. Right? Because let's say you have a Bollinger Band model. All you do is to get one set of backtests. Okay, Sharpe ratio 1.5. Is that luck or not? And some people say, oh, yeah, let's simulate 10,000 price series and run this strategy. That is an imperfect solution because, frankly, no simulation can capture all the nuances of the market. Because nobody understands the market. If you don't understand the market, how can you really simulate the market realistically, right? The problem of simulation is almost as difficult as the problem of trading the market because simulating it realistically implies that you really understand what drives the market. And if you already know what drives the market, your trading strategy will be doing very well already. You don't need to simulate the market to do that. So, because it's so hard to simulate the market, it is therefore very hard to assess the probability that, to create an error bar for the Sharpe ratio that you compute and to create an error bar for your entire back test. That is not the case for machine learning model because machine learning model is easy to generate multiple back tests. You merely need to switch the random seed and the outcome will be completely different. Because essentially you can say that unlike a traditional quantitative strategy, a machine learning based strategy is not deterministic. That is something that many people overlooked. They thought, oh, garbage in, garbage out, machine is a machine, right? It's all the knobs and pipes are fixed. So whatever input you put in, outcomes exactly same output. If you put in the same time series, it come out the exact same set of trades. That is not the case. Machine learning trading model is intrinsically random because most machine learning model, when they are trained, requires randomness. Hey, why do we call a random forest random forest, right? Clearly, there's something random about it. So just look at the word random forest. It implies that there are intrinsic randomness in a machine learning model. It depends on your random seed. Therefore, every backtest potentially give you different result. But that's a good thing. It's not a bad thing. It's a good thing because that kind of randomness allows you to assess the statistical significance of your backtest. If you feed in 10,000 random seed and therefore create 10,000 backtests, what is the percentage that these backtests give you a Sharpe ratio greater than 1, for example? It's a simple answer. You can find out from looking at your experiments. You can't do that with traditional quantitative model. So that's I would say another major plus of applying machine learning trading to trading instead of traditional quantitative strategies. So let's take a step back. What are the 3 steps of applying machine learning to trading? There is the data science problem, and then there's the machine learning problem, and then there's the trading strategy problem. Let's tackle it one by one. The first step is financial data science. And many people new to applying financial machine learning to finance, applying machine learning to finance would be surprised to know that this is the step that is the most difficult and the most time consuming. It typically takes up 80% of the time of constructing a strategy. The machine learning problem itself is rather trivial. I'll get to that later. But the financial data science part usually take up 80%. Don't take my word for it. In the next slide, I'll tell you who said that. Because there are usually numerous problems with financial data. You would not believe the amount of problem with financial data, even from reputable vendors. For example, some of you may be familiar with CompuStat data, which generate, which provide company fundamentals. But not all of you will realize that the version of the CompuStat data that they distribute to universities for free contain look-ahead bias. And the reason it contains look-ahead bias is because they provide you with restated financials. So if the company, let's say 1 year from after they announce earnings, they go back because the auditor found some irregularity and go back to revise the earning. That earning was somehow replaced the original earning. And so the data wasn't point in time. And if you're using that data to learn, your machine learning model will look great in backtest and will completely fall apart in live trading. That is CompuStat data, not your cost or basement factories data, and that's what they give to universities. So, but they of course have a better version called a point-in-time data, which is available if you pay them big bucks. So that's one problem. There are other problems. I have seen, like, for example, news sentiment data, where the company that processed those news suddenly went back to change some parameters in how they process that news. That parameter probably is adjusted based on how they calibrate this news sentiment to market reaction. And if you already know the market reaction, of course you would regard that news as important, right? That's no brainer. So that is another deep source of problem. So basically, I could not trust any sentiment data. No matter who give me the sentiment data, I don't trust them because they can always go back to re-engineer the process to make them look good. I do not trust anybody. You are the only person you can trust yourself. The only person you can trust is yourself. If you're going to get your hands on raw news data, You have to process them into new sentiment and relevant score. You know you haven't introduced look ahead bias. Anybody else, there's no way to know if their data has look ahead bias. It's just not possible to know. So data is a huge problem. Take up 80, sometimes 90% of the time. Once you get your data in place and engineering features, then getting good data is not the only step. After you get the data, you have to engineer them into useful features. That is another extraordinarily tedious step. How to get the raw data into useful features? You need domain expertise. You cannot just, there's a genius from Google, let's hire them, pay him or her $1 million salary and get him to work in our hedge fund and we'll be making billions. That does not work that way. Unless this person from Google has deep financial domain expertise, it is going to be a complete failure. So that's a very difficult problem. So you cannot avoid it. It's not really, a machine can't really handle it. It requires human intelligence. So that's kind of paradoxical. In a financial machine learning problem, the biggest difficulty, the biggest hurdle is the first step, financial data science, and that is the step that machine cannot solve for you. It requires human intelligence. The next problem, which is machine learning problem, the machine learning proper, is a problem that has been solved many, many times. Google has solved it, Facebook has solved it, you probably have solved it. Every single person can install a free program on a desktop and apply machine learning. Now, I make it sound like so easy, but of course, if you're not a software engineer, there's going to be some problem. So my company, PredictNow.ai, was founded as with a view towards automating this process. It's a no-code service, so you don't have to be a software engineer to utilize machine learning. But let us be frank. This is not the difficult problem. It is a problem that is essentially solved by every single tech company in the world, including mine. So let's not talk too much about it. The third step is trading strategy construction. Now the machine has produced prediction, either a classification prediction, like the market is going to go up or down, or your strategy is going to make money or not, or it can make a regression prediction, which is Apple is going to go up 2% tomorrow, Facebook is going to go down 3% tomorrow, something like that. That's a regression prediction. Now that you have this one, is that problem solved? Are you done? No, you're not done, because just because you have this prediction, that's not the final step of the strategy. You need to put together this prediction into a coherent strategy, and you have to backtest this strategy, and you have to assess the statistical significance of this strategy. Now, there are lots of platforms that can help you to do that. You can write your own in Python, in R, in MATLAB. You can use Quant Connect. You can use Quant Instill. That problem, the technological part is solved. There are dozens of backtest programs you can use, but the human intelligence part is still required, obviously. The human intelligence part of that is less difficult than the first part, which is financial data science, because it is intuitively clear that if the program says that Apple is going to go up, most likely you're going to buy it. Its only question is how much, right? So once you have prediction, to put them together into a portfolio is not automatic, but it is not that hard, I would say. There are standard, if you read your papers, if you read your finance textbook, probably you just follow a fairly standard routine to convert prediction into backtest. So it's not that hard, but it does require some domain expertise. It's still not completely automatic. I'm watching the time. I see that we are, I only got through 6 slides, but that's okay, because I'm definitely going to stop in 5 minutes, so as to take a question. So by the way, the person who said that 80% of machine learning, not just financial machine learning in general, is data science, the quote is from the IBM SVP of cognitive software. So this is a slide about to drill down on the difficulties of financial data science. I already told you some of it. So I'm not going to go through them point by point. It's just too numerous it's just too tedious to talk about. It's just mind-bogglingly complicated, the data science part of the problem. So let's skip that. But one key feature is that you have to make those features stationary. And so, one of the key mistakes that many people commit when they are not from finance and try to apply the normal data science know-how to finance is that they forgot that in finance, most of the data are not stationary. They cannot be used as features. For example, let's say the price of Spider ETF. That's definitely not a stationary feature. If you stick that into as a predictor of a machine learning program, it is essentially worse than useless. So you have to change them, convert them into a stationary price series, either by taking the percent differences or by using a process called fractional differentiation. But since time is running short, I will only refer you to the textbook by Dr. Marcus Lopez de Prado to further study the process of fractional differentiation. What machine learning model to use? They are the simple ones. You can call linear and logistic regression models machine learning, but they are too simple in my field. They are essentially linear models. No good. It's good if you have fewer than 10 predictors. When you have more than 10 predictors, forget about it. Deep learning model like deep neural network, no good. Too complicated for finance. We don't have enough data for that. We don't have enough data to support fitting 20,000 parameters, which is a typical number for deep learning. Random forest, that's the best. We choose it. Most financial machine learners choose it because it has just the right complexity. Not too many parameters to fit, not too few. And it does capture nonlinearity very well. Okay, so in the last 5 minutes, I want to talk a little bit about meta labeling. So as I advocated earlier, if you want to use machine learning successfully to apply to finance, do not predict the market. Instead, predict whether your own strategy is going to be profitable, because that is a unique data set that only you are trying to predict. And that technique is called meta labeling. And again, I refer you to Lopez de Prado's textbook. He talks a lot about meta labeling. And that is not just theory. Speaking from personal experience, I can tell you I have never had any success predicting the market, but I have a lot of success predicting whether my own strategy is profitable using this technique. So that's the remaining slides are essentially elaboration of that idea. So I'm not going to, given the time constraint, I do not wish to burden you with going through them. I would recommend you read my blog post talking about this notion of meta labeling applied to finance on epchen.blogspot.com instead. But I already explained why meta labeling are important. I apply it to our trading strategy called Tail Ripper, which this year had a spectacular run, but that's not the point. The spectacular run is not due to machine learning, in case you misunderstand. It has nothing to do with machine learning. What is due to machine learning is when we didn't trade. I can tell you something amazing about the machine learning is that on February 1st, when nobody think that the virus is going to have any impact on the world economy, our machine learning model detected tail risk and started to aggressively hedge tail risk. We were dumbfounded by the presence of this machine learning model. And then again, a few days ago, this machine learning program tells us to stop hedging tail risk. If we hadn't stopped, we would suffer a tremendous loss because of the Pfizer announcement. The Pfizer announcement of the vaccine, in case you didn't know, caused a huge move in the financial market that is unprecedented. And that unprecedented move, which is also called momentum crash, will basically wipe out a lot of momentum funds. We are a momentum fund. And my machine learning model, a few days ahead of that announcement, tells us to stop trading that strategy. I cannot believe how percentages. It's just incredible, as if it is some inside knowledge of Pfizer. But no, all it takes in is 170 plus global market variable. But just looking at that, they decided that the time is right to stop running this strategy. And boy, we are glad that we follow the advice of machine learning. So I am now a major believer in machine learning given this year's experience. I would refer to the references that my coworker and Nancy is the English name of my coworker, man. We published a preprint, which is accepted for publication at the Journal of Financial Data Science about feature selection. As I said, feature selection is important if you want to explain to an investor why the hell you lost them 10% last month. And then I also published a white paper with another colleague, Dr. Silbano, on how to use machine learning to predict macro variables. You will be surprised how accurate we can predict non-farm payroll surprises using an alternative data. WeWeCorp is a company in Toronto, by the way. They provide us with the data for this study. And of course, I refer you to Laura Prado's textbook on advances in financial learning, and my book on machine learning, which provides some basic knowledge on artificial intelligence. Before you read Dr. Marcus Lopez's book, I recommend you read my book, Machine Learning, because otherwise you won't understand much of it. Because Lopez really are targeting a more sophisticated audience. If you never used machine learning before, I do recommend you start with my book, or you start with the textbook by Murphy called Machine Learning: A Probabilistic Perspective. And also you can check out many of our other white papers and blog posts and talks and presentations on predictnow.ai FinML page.